Auto trend lines provide 5 key benefits for traders and analysts. First, auto trend lines dramatically improve time efficiency. The same analysis that might take minutes to perform manually can be completed in milliseconds. Second, auto trend lines eliminate subjective bias. When 5 different traders analyze the same chart, they often draw different trend lines based on their biases and experience. An algorithm applies consistent rules every time. Third, auto trend lines provide consistent analysis across different timeframes. The same algorithm works equally well on daily, weekly, or monthly charts, ensuring your analysis remains coherent. Fourth, auto trend lines can identify patterns that might be missed by the human eye. Algorithms can detect support and resistance levels, trend channels, and other patterns even in complex market conditions. Finally, auto trend lines excel in volatile markets where trend identification becomes challenging. When price action is noisy, algorithms can filter out the randomness and identify the underlying trend direction. By leveraging these 5 key benefits, traders can make more informed decisions, analyze more markets efficiently, and potentially improve their trading results. While auto trend lines can be powerful tools, they come with several important limitations that traders need to understand. First, auto trend lines may generate false signals during choppy sideways markets where no clear trend exists. Algorithms may draw contradictory trend lines as they struggle to identify a meaningful direction, leading to conflicting trading signals. Second, historical data limitations can affect accuracy. Algorithms need sufficient data points to establish reliable trends. With limited data, the algorithm might draw very different trend lines, making it difficult to determine which pattern is most reliable. Third, market noise and volatility can trigger premature trendline adjustments, causing the algorithm to redraw lines too frequently. As prices become more volatile, auto trend lines may constantly adjust, sometimes breaking important support or resistance levels prematurely. Finally, different trading platforms use different algorithms, leading to inconsistent results across trading software. Even with identical price data, 2 different platforms might draw trend lines with varying angles and positions, potentially giving contradicting signals. Understanding these limitations is critical when incorporating auto trend lines into your trading strategy. By being aware of these challenges, you can use auto trend lines more effectively while minimizing their drawbacks. For maximum effectiveness in trading, combining auto trend lines with complementary indicators creates a comprehensive analysis framework. Let's start with a price chart and an auto trend line that identifies the primary market direction. Volume indicators help confirm the strength behind a trend identified by auto trend lines. Higher volume during trend development suggests stronger participant commitment. Momentum oscillators like RSI or MACD can signal potential reversals when they diverge from the trendline direction. This divergence often precedes price reversals. Moving averages provide additional support and resistance levels that can reinforce auto trendline signals. When price interacts with both a trendline and moving average, the signal strength increases. This multi-indicator approach creates a more robust trading system that reduces false signals and improves timing. Each indicator provides a different perspective on market conditions. By combining auto trend lines with volume, momentum, and moving averages, traders can develop a comprehensive analysis framework that's stronger than any single indicator alone. Let's examine practical trading strategies using auto trend lines, starting with trend-following approaches. Trend-following strategies capitalize on established trends using auto trend lines. Traders identify the primary trend direction and enter positions after price pulls back to the trend line. When price touches the trend line and begins to move back in the trend direction, traders enter positions. This approach maximizes profit potential while managing risk by trading with momentum. Breakout strategies focus on moments when price breaks through established auto trend lines, signaling a potential change in trend direction. When price successfully breaks through a significant trend line, it often indicates momentum in the new direction. Traders enter at the confirmation of the breakout and place stops below the broken trend line. Mean reversion strategies exploit the tendency of prices to return to their average trend after extreme movements. These strategies identify when price extends too far from the main trend line. When prices become overbought, traders may enter short positions, expecting a move back toward the mean. Conversely, in oversold conditions, traders look for buying opportunities as prices are likely to revert upward. For all trading strategies utilizing auto trend lines, proper risk management is essential for long-term success. Implementing stop-loss orders is non-negotiable. Stops should be placed beyond key trend lines to avoid being triggered by normal market noise. Limiting risk to 1 to 2% of capital per trade protects your account from significant drawdowns. To effectively implement auto trendline trading strategies, choose an approach that matches current market conditions. Use trend following in directional markets, breakout strategies during consolidation periods, and mean reversion when markets are range-bound. Regardless of the strategy chosen, consistent risk management and trading discipline are critical success factors. By combining the objective signals from auto trend lines with proper money management, traders significantly improve their chances of long-term profitability.